Hi everyone, welcome back to the Intelligent Investor channel. In this video, I'm going to talk about why I think Tesla stock is likely undervalued now compared to its intrinsic business value. More importantly, I will talk about why I think the market is wrong about Tesla's long-term prospects and long-term strategy again. Just to give you some context, right before making this video, Tesla released its Q1 earnings. Tesla's operating margin was down a lot compared to last year and the quarter before because Tesla started cutting prices on Model 3 and Model Y in order to increase vehicle sales and increase market share in the EV market. Obviously, this hurts Tesla's gross margin and operating margin. Over the next several quarters, Tesla is planning to keep Model 3 and Model Y prices low in order to sell more cars. This means Tesla's gross margin and operating margin will likely remain low over the next several quarters. Of course, the market does not like this strategy at all. This is why Tesla stock was down as much as 10% right after Tesla's earnings call. In my opinion, I think the market is very short-term focused. The market is much more focused on Tesla's quarterly earnings instead of Tesla's long-term strategy over the next 3 to 5 years. I think the market misunderstood Tesla's long-term strategy, which in my opinion is much more important. At the time of making this video, Tesla's market cap is at $487 billion. Tesla's market cap was as high as $1.23 trillion during the peak of the last bull market in November 2021. Now, Tesla stock is down as much as 60% from its most recent peak in November 2021. I think the more important question is this: is Tesla stock undervalued now compared to its intrinsic business value? I will show you how to calculate Tesla's intrinsic value in this video. So in this video, I'm going to talk about these topics to see if Tesla stock is really undervalued now. I will talk about why the market is wrong about Tesla's long-term prospects, Tesla's financials review, Tesla's biggest competitive advantage and long-term prospects, Tesla stock valuation, and will I buy Tesla stock? If you like this video, make sure to hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock analysis and investing videos a week that will help you become a great investor. Each video usually takes me 20 to 30 hours to make, so if you like this channel and want to support it, check out my Patreon blog in the video description. Our goal is to help all our members grow their stock portfolios to over 7 figures over time. Once you become a Patreon member, you can follow all the stocks I'm investing in for the long term and download the latest intrinsic value calculators for all the stocks I'm analyzing, so you will know when a stock becomes undervalued, fairly valued, or overvalued now. Also, you will have access to all my latest stock ratings for all the stocks I'm analyzing. The link is in the video description. Take a look, let's start. So why is the market wrong about Tesla's long-term prospects again? Tesla's strategy right now is to make Model 3 and Model Y prices as low as possible in order to have the largest market share. Tesla's price-cutting strategy is to increase vehicle sales, achieve quarterly vehicle delivery goals, and have the largest EV fleet in the market in order to collect more autonomous driving data from each car. The downside is that cutting prices to increase demand always hurts Tesla's operating margin, at least for the short term. Once Tesla's full self-driving FSD service is out of beta, Tesla's management believes that many customers will pay for the FSD service, which can cost as much as $15,000 or even higher if you buy the service up front. Many customers may choose to pay a subscription fee to use Tesla's FSD service. By having the largest EV market share, Tesla believes that they can cross-sell many services that have high margins, such as full self-driving and insurance services, to many Tesla customers. In the long run, Tesla's management believes that this strategy works much better for the company. This from Business Insiders. Tesla has cut prices 6 times this year. The entry-level Model 3 now costs less than $40,000, down from $62,990 at the start of the year. The Model S and Model X are also 20% cheaper than they were at the beginning of 2023. In comparison, the market does not like Tesla's aggressive price-cutting strategy in order to increase market share. The biggest risk is that Tesla may need to cut prices further to increase demand, at least during this recessionary period. Also, I think this aggressive price-cutting strategy suggests that Tesla is facing a lot of competition from other major competitors such as BYD in China, Volkswagen, Ford, GM, Mercedes, and BMW. The market thinks that Tesla should still keep Model 3 and Model Y prices high, so Tesla can still maintain a higher gross margin and a higher operating margin like before. In my opinion, if Tesla does not lower prices for Model 3 and Model Y, Tesla may not be able to achieve its quarterly delivery goals. It will take several years for us to know which strategy works better for Tesla. Lowering Model 3 and Model Y prices to increase market share at the expense of operating margin, or keeping prices high to have a higher operating margin. If I have to make an educated guess, I think Tesla should increase market share now by keeping Model 3 and Model Y prices low, so most of the Model 3 and Model Y vehicles can qualify for the US EV tax incentive. Tesla can always increase prices later on when interest rates are much lower. When interest rates are high, it's much more expensive for customers to buy Tesla Model 3 and Model Y. Many customers cannot afford to buy EVs when car financing rates are high because the monthly payments are much higher. Many customers will rather postpone buying their EVs when there are a lot of uncertainties in the economy. I think this is why Elon Musk decided to keep Model 3 and Model Y prices as low as possible to increase market share now during this recessionary period. Before showing you Tesla's latest financials, I want to share with you the most important parts of Tesla's most recent earnings call. Elon Musk and his management team said this. And while we reduced prices considerably in early Q1, it's worth noting that our operating margin remains among the best in the industry. We have taken a view that pushing for higher volumes and a larger fleet is the right choice here versus a lower volume and higher margin. However, we expect our vehicles over time will be able to generate significant profit through their autonomy. So we do believe we're laying the groundwork here, and that it's better to ship a large number of cars at a lower margin and subsequently harvest that margin in the future as we perfect autonomy. This is an extremely important point. Regarding the Cybertruck, we continue to build alpha versions of the Cybertruck on our pilot line for testing purposes. It's a great product and we're completing the installation of the volume production line at Giga Texas, and we're anticipating having delivery events, a great delivery event probably in Q3. I want to reiterate the philosophy by which we're operating the business this year. Our approach is to grow volumes as quickly as possible in both our vehicle and energy businesses. We plan to continue to invest heavily into our future plans, which include the Cybertruck next-gen platform, in-house cell production, energy storage business, and our autonomy and AI-enabled products. And we plan to do this while keeping the business financially healthy and industry-leading. To accomplish this, we need to remain focused on cost efficiency and working capital, and in particular, unwinding the strategic inventory build-up left over from the pandemic. I think we're in uncertain times, and if somebody got a crystal ball they can lend me, I really like to borrow it, but these are uncertain times. It's just pure speculation, stormy weather for about 12 months, and then provided there are no major geopolitical wildcards that show up, that things start getting sunny around spring next year. I mean, there's really two macro factors that are tricky, the biggest being the interest rate. So if there's a very high Fed rate or interest rates are very high, that's every time the Fed raises the interest rates, that's equivalent to increasing the price of a car. It makes the cars less affordable because people are able to buy cars as a function of what they can afford on a monthly basis. So it's just almost directly equivalent to a price increase. Then the other factor is whenever there's uncertainty in the economy, people will generally postpone big new capital purchases like a new car. This is natural human reaction. So if people are reading about layoffs and whatnot in the press, they're like, well, they might be worried about, they might be laid off. So then they will be naturally a little bit more hesitant than they would otherwise be to buy a new car. Now, this is just the nature of the auto industry. There will be an amount of pent-up demand for new cars, so it goes through cycles. We do have this unique strategic advantage that we have. We're making a car that if autonomy pans out, we think it will, where the assets actually will be worth a hell a lot more in the future than it is now. So it's taken to be possible to sell it at zero profit, but still have the net present value of future cash flows associated with that asset very significant. Tesla is essentially prioritizing vehicle sales and EV market shares over operating margin in this high inflation and recessionary market. Tesla believes that it can make up the gross margin later on by selling the FSD service or the robotaxi service later on. Just to compare, if you look at this here, you can see Tesla's trailing 12 months of operating margin is still far ahead of the overall auto industry, even after Tesla started the price war and started cutting prices. Tesla has the highest operating margin compared to traditional car makers and EV makers. I want to show you Tesla's most recent financials here. After Tesla started the price war and started cutting Model 3 and Model Y prices, Tesla's gross margin dropped to 19% in Q1, and its operating margin dropped to 11% in Q1. The biggest risk here is that Tesla may need to cut prices further if Tesla needs to increase vehicle sales in the upcoming quarters. This means Tesla will likely have a lower gross margin and a low operating margin over the next several quarters if Tesla wants to increase market share and achieve its 1.8 million annual vehicle delivery goal in 2023. As of now, Tesla is still earning the most revenue from selling EVs, including the Model 3, Model Y, Model S, and Model X. Cybertruck will be the next mass consumer EV after the Model 3 and Model Y. In the most recent quarter here, Tesla earned 86% of its total revenues from selling EVs. Around 6.6% of total revenues came from Tesla's energy storage business, and the rest revenues came from Tesla's services. The important part is this: you can see Tesla's energy storage business is growing at a much faster rate than Tesla's automotive business. Going forward, Tesla's energy storage business may become a much larger revenue contributor to Tesla. Just keep this in mind. In terms of liquidity and balance sheet items, I think Tesla has a very strong balance sheet. For example, in the most recent quarter here, Tesla had $2.68 billion in debts. In comparison, Tesla had $22.4 billion in cash. This means Tesla can pay off all its interest-bearing debts and still have nearly $20 billion of cash to invest in its businesses. In terms of vehicle delivery growth, Tesla's vehicle delivery growth has slowed down a lot in recent quarters. For example, according to the financials here, Tesla's total deliveries only grew 36% year over year. In comparison, Tesla aims to achieve an average of 50% in annual vehicle delivery growth over a multi-year period. This means Tesla's current vehicle delivery growth is below the 50% CAGR target. One reason is that Tesla is facing a lot of competition from competitors such as BYD in China, Volkswagen, Ford, GM, Mercedes, and BMW. I believe this is why Tesla decided to cut prices to increase demand and gain more market share. I talked about this earlier. Car financing rates are much higher than before, so many customers are likely not buying EVs right now until interest rates are lower and until there are less uncertainties in the market. In terms of free cash flow growth, you can see Tesla's operating cash flow and free cash flow decreased a lot in the past 2 quarters. Again, the biggest reason is that Tesla started cutting prices aggressively to increase demand and to sell more Model 3 and Model Y vehicles. I think Tesla's cash flow will continue to slow down over the next several quarters until the US Fed stops raising interest rates. Once the Fed starts lowering rates, hopefully starting in 2024, I believe Tesla's vehicle sales and free cash flow growth will accelerate again because many customers will start buying EVs again. Going forward, I believe Tesla will still have a lot of competition. For example, in 2022, BYD was the largest car maker in plug-in vehicles, well ahead of Tesla. Plug-in vehicles include both battery-powered electric vehicles and plug-in hybrid electric vehicles. Based on what I know, BYD has been growing much faster than Tesla in China, mainly because BYD sells very cheap vehicles made in China. In the battery-powered electric vehicle market, Tesla was the largest EV maker in 2022. BYD was the second largest EV maker in 2022. BYD's EVs are generally much cheaper than Tesla's Model 3 and Model Y. This is why I think BYD may eventually become the largest battery electric vehicle maker in the world by selling very cheap EVs. But BYD is not as profitable as Tesla. Here's another example. Many companies are making battery-powered EVs and plug-in hybrid electric vehicles in China. According to the latest data here, you can see BYD already sells the most EVs in China, even more than Tesla's Model 3 and Model Y combined. BYD's biggest competitive advantage is its large economies of scale in making EVs and other plug-in vehicles. BYD is also one of the largest battery makers in China. BYD is not as profitable as Tesla because BYD mainly sells very cheap EVs and cheap plug-in vehicles. In the long run, I believe Tesla's biggest competitive advantage is its large economies of scale or cost advantage over other competitors. Based on what I know, it's very easy for car makers to design their own EVs, but it's much harder to achieve large economies of scale like Tesla to make over 1 million EVs each year. Most car makers are losing a lot of money to make their EVs because they have not achieved large economies of scale yet. In fact, many car makers are only starting to make their EVs at a much smaller scale compared to Tesla. Traditional car makers such as Ford, GM, BMW, and Mercedes are likely losing a lot of money to make their EVs. They have to use their gross profits from selling internal combustion engine cars to offset the large losses from selling their EVs. Here's another competitive advantage that is very hard for other competitors to copy. At the time of making this video, the average cost to make each Tesla vehicle is around $36,000 to $37,000. This is much lower than other competitors' average cost to make each EV. If Tesla decides to cut prices further to increase market share, many car makers will not be able to cut their EV prices as much because they are already losing a lot of money making each EV. This from Morningstar. It explains Tesla's biggest competitive advantage is cost advantage over other EV competitors. We think Tesla benefits from a cost advantage in electric vehicles production thanks to its manufacturing scale. Tesla's total vehicle volume has grown from just over 100,000 in 2017 to over 1.3 million deliveries in 2022. During the same period, the company's average cost of goods sold per vehicle has fallen over 50%, from $84,000 to under $39,000, and gross profit margins have expanded from 20% to 26%, excluding the sale of regulatory credits. While some of this is due to manufacturing a greater proportion of mid-sized cars and SUVs versus luxury autos, the majority of the cost of goods sold decline has come from the company's focus on reducing manufacturing costs due to scale. Legacy automakers are gradually transitioning to battery electric vehicle production from internal combustion engines, but we expect they will be saddled with legacy internal combustion engines ICE costs for a long time. Even as legacy automakers begin to produce more EVs, we expect Tesla will continue to have lower costs as it has outlined a plan to further reduce battery cell costs by 56% over the next several years. With Tesla's cost per vehicle set to fall, incumbent automakers may take years to catch up to Tesla, if ever, as they won't want to build many new factories from scratch like Tesla is doing. In terms of long-term prospects, I think the most important development is that Tesla is planning to decrease its production cost per vehicle by as much as 50% for Tesla's next-gen platform. Tesla is planning to achieve a 50% reduction in cost per vehicle by improving its manufacturing processes to be much more efficient, using less footprints in gigafactories, using a new assembly line, improving battery productions, reducing battery costs, improving the powertrain, moving to the 48-volt system that's more efficient, using more in-house chips and controllers, using the gigapress, and using fewer components to make each car. At the time of making this video, the average cost to make each Tesla vehicle is around $36,000 to $37,000. If Tesla can reduce its average cost per vehicle by 50%, Tesla's average cost per vehicle will become as low as $18,500. Just to compare, back in 2017, it cost Tesla $84,000 to make each vehicle. Now it costs Tesla about $36,000 to $37,000 to make each vehicle. Given Tesla's track record in mass manufacturing EVs and improving manufacturing processes, I think Tesla has a very good chance to reduce its average cost per vehicle by as much as 50% going forward. This means Tesla can potentially introduce a much more affordable $25,000 vehicle that will still be profitable for Tesla. Tesla's next most important product will be the Cybertruck. This will be a mass consumer product similar to the Model 3 and Model Y. If I have to guess, I think the $25,000 EV will be the next most important product for Tesla after the Cybertruck, because it will be another mass consumer product to help Tesla achieve 20 million vehicles a year. Tesla delivered about 1.3 million vehicles in 2022. Tesla is planning to deliver about 1.8 million vehicles in 2023. Over the long run, Tesla is aiming to produce 20 million vehicles a year by 2030. Obviously, this is a very ambitious goal. For this to happen, I believe Tesla will need to reduce its average cost per vehicle by 50%. Mass manufacture is the Cybertruck, and eventually release the $25,000 EV that is even more affordable than the Model 3 and Model Y. I want to show you my vehicle forecast for Tesla here. Tesla is aiming to deliver 1.8 million vehicles in 2023. I think Tesla will deliver slightly lower than 1.8 million vehicles in 2023 because Tesla is facing a lot of competition from BYD and all other EV makers. More importantly, car financing rates are high now, so many customers are likely delaying their EV purchase until interest rates are lower and until there are less uncertainties in the market. Tesla is aiming to produce 20 million vehicles a year by 2030. Again, I think this is a very ambitious goal. I believe it will take Tesla much longer to achieve this goal. Just to compare, Toyota sold nearly 10.45 million vehicles in 2022. Realistically, I think Tesla's annual vehicle delivery growth will likely slow down going forward because there's a lot more competition in the EV market now. Tesla is also much larger than before, so it will be very hard for Tesla to maintain an average of 50% in annual vehicle delivery growth going forward. If I have to make an educated guess, I think Tesla will probably deliver between 5 million to 10 million vehicles a year by the end of 2030. So this will be much lower than Tesla's long-term goal to produce 20 million vehicles a year by 2030. In terms of consensus revenue forecast, Wall Street analysts expect that Tesla can still maintain 20% to 30% in annual revenue growth each year over the next 5 years. I think this revenue growth rate is reasonable because there is still a large demand for EVs around the world. More customers will switch from internal internal combustion engine cars to EVs over the next 10 years. In terms of consensus EPS forecast, Wall Street analysts expect that Tesla's EPS will drop year over year in 2023. I think this will be the case because Tesla started the price war and started cutting prices to increase demand. Of course, this will hurt Tesla's operating profit at least throughout 2023. Tesla's EPS is expected to grow again starting in 2024. Here's my prediction for Tesla's market cap. At the time of making this video, Tesla's market cap is at 487 billion. Tesla's market cap was as high as 1.23 trillion during the peak of the last bull market in November 2021. I believe Tesla's market cap will eventually grow back to over 1 trillion over the next 3 years when the Fed starts lowering interest rates and when Tesla delivers around 3 million vehicles a year. Just to compare, Tesla is expected to deliver around 1.8 million vehicles in 2023. Elon Musk made this very bold prediction before. He believes that Tesla may eventually be worth as much as Apple and Saudi Aramco combined, or over 4 trillion in market cap. He said, "Now, I'm of the opinion that we can far exceed Apple's current market cap. I see a path for Tesla to be worth more than Apple and Saudi Aramco combined." My prediction is much more conservative than Elon Musk's prediction. In my opinion, I think Tesla will likely reach a 1 trillion market cap again when the Fed starts pivoting and when Tesla sells around 3 million vehicles a year. I want to show you how to calculate Tesla stock's intrinsic value per share here, so you will know when Tesla stock becomes undervalued, fairly valued, or overvalued. If you want this calculator, you can download it from my Patreon blog. The link is in the video description. These are the key assumptions in this calculator. First, I define Tesla's intrinsic value as its future free cash flows discounted to the present day. I used a discount rate of 12% here. You can use a higher discount rate here if you want to be more conservative. The expected free cash flow margin is 8.9%. This is consistent with Tesla's free cash flow margin over the past 3 years. You can use a lower free cash flow margin here if you want to be more conservative. Over the next 5 years, I believe Tesla's revenue will grow at a compound annual growth rate, CAGR, between 20% and 30% each year. I think this revenue growth rate is reasonable. It's also consistent with the Wall Street analyst consensus revenue forecast I just showed you earlier. Let's go over these 3 case scenarios here: worst case, normal case, and best case scenarios. Under the worst case scenario, we're forecasting Tesla's revenue will grow at a CAGR of 20% over the next 5 years. If we forecast Tesla's free cash flow over the next 5 years and discount the free cash flow to the present day, Tesla's intrinsic value should be around 569 billion for the entire company, or $164 per share. I'm giving this scenario a 25% probability here. Under the normal case scenario, we're forecasting Tesla's revenue will grow at a CAGR of 25% over the next 5 years. If we forecast Tesla's free cash flow over the next 5 years and discount the free cash flow to the present day, Tesla's intrinsic value should be around 690 billion for the entire company, or $199 per share. I'm giving this scenario a 50% probability here. Under the best case scenario, we're forecasting Tesla's revenue will grow at a CAGR of 30% over the next 5 years. If we forecast Tesla's free cash flow over the next 5 years and discount the free cash flow to the present day, Tesla's intrinsic value should be around 831 billion for the entire company, or $239 per share. I'm giving this scenario a 25% probability here. If we add all these numbers here, Tesla's intrinsic value should be around $200 per share. Just to compare, Morningstar estimated Tesla's intrinsic value to be slightly higher at $215 per share. This means I believe Tesla is likely undervalued a lot at the time of making this video. So will I buy Tesla stock? Yes, I will likely buy more Tesla shares going forward whenever it's substantially undervalued. I already have Tesla shares in my portfolio here. I'm not too worried about it even if it's down a lot because of the current macroeconomic headwinds. I like Tesla's large economies of scale competitive advantage and its lowest cost to make each electric vehicle compared to other competitors. Personally, I believe Tesla's manufacturing processes and the cost to make each vehicle will continue to improve going forward. It's very hard for other competitors to copy Tesla's large economies of scale to have the lowest cost to make each EV. To reduce risk, I will likely sell half of my Tesla shares once Tesla hits a 1 trillion market value again. My strategy is to always invest in the best businesses at wonderful prices. Personally, I like near monopoly businesses that have large economic moats, first-class management, great long-term prospects, great products and services, increasing earnings, and increasing free cash flows over time. I like to buy shares when they become undervalued to reduce risk. For example, I like companies such as Apple, Microsoft, Alphabet, Visa, and MasterCard, so I like to focus on investing in these companies over the long run. Now, all these are only my opinions and my analysis based on my research. They are not financial advice. There are always risks associated with investing. You will need to do your own research and do your extra due diligence first before investing in anything. Thank you for watching this video and supporting our channel. This is Victor from the Intelligent Research channel, and I will see you in the next video.